Hello traders. It is time for the risk management section of my series. It's been a few weeks since I've been away for New Year's, but I will be making some more frequent content now. But before we talk risk management as proof I'm actually listening to your feedback, I have a small gift for you all. I've noticed some of you want some example trades to see, as you get the concept behind my style of trading but want something clear and visual to help in your understanding. So I'm going to walk you through a trade I took on Friday so you can see the power of relative strength in action. Here are two charts. These are both using the daily candles. On the top you can see the chart of Bitcoin, and on the bottom is a shitcoin I've been watching called Dash. Why is this Pajit coin in my maybe pile? Because as Bitcoin is sloping down, this shitcoin is staying flat, especially in the last 10 or so candles, which is what matters most. This shitcoin has relative strength versus Bitcoin on the daily candles. Let's move down to the 5-minute candles. I will try to mimic how it unfolded with this sliding shit so you know what to look for. You can see at the start Bitcoin is flat when suddenly there is a sell-off creating a new trading range. We then recover close to the previous level before the sell-off. Suddenly Bitcoin tanks, but if you watched my last video then you already know what's going on. Institutions have stepped back and are generating liquidity for themselves. It's at this time you need to be flicking through your maybe pile and looking at the 5-minute charts to see if the shitcoins in your maybe pile are getting buried or are showing their relative strength. The protagonist in this anime, a Pajit coin called Dash, isn't dumping, it's staying flat through this liquidity grab. You can see it at the bottom now. This is the coin to trade. Once Bitcoin finds support, we go long on Dash. You can flick to Heikin Ashi candles to find a reversal if you want. What follows is Bitcoin staying relatively flat but Dash starts to push higher. As I'm making this right now, Bitcoin was only able to make a 1% move up. But Dash made a 12% move higher. That's 12 times the amount of profit potentially available to you in this example. Not only do you get 12 times the payout, but it's more likely that this trade works. It is by far a higher probability trade than had you have just traded Bitcoin. Now let's talk risk management. It's clear to me from observing crypto YouTube that no one has the slightest fucking clue what leverage is or how to use it. And because of this you all seem somewhat scared too. That's understandable, since if you use leverage the way normie YouTube tell you to, you will blow up your account. Hypothetically, say you have a $1,000 account, they will tell you to buy all in on 20x leverage and open a $20,000 position. Even if you have a 60% win rate, you can still expect 5 or 6 lost trades in a row every 100 trades. You need to be sizing way smaller or you're doomed the second you have an unfortunate streak of luck. Rather than thinking how much leverage can I cram into my trade to make my millions as fast as humanly possible, you need to be thinking, if I was to lose this trade right now, how do I make sure that the loss isn't more than 2% of my trading account? Not losing more than 2% of your account per trade is how you are going to handle your drawdown so you don't blow up. Let's say you take 100 trades. 60 of them you win, and 40 of them you lose, which is really good. Somewhere in those 100 trades the max drawdown average will be 6 lost trades in a row. Let's also say in this hypothetical trading simulator that for every trade you win the payout is 2 times the amount you lose on a losing trade, or 4% gained. Well, let's do the math. Over your 60 winners you make a 240% return on your account, and on your 40 losers you lose 80%. That means in total over 100 trades you made a 160% return on your trading account. But remember, somewhere in those 100 trades the average for that win rate is that you lost 6 trades in a row. This is why not losing more than 2% is so important, even with only 2% losses. That's 12% of your account that's going to be taken from you at one time every 100 trades. Also remember that if you're new to trading you can expect lower win rates. If you win 45% of your trades you can expect to lose consecutive 11 in a row every 100 trades. That's 22% of your account wiped. Hopefully now you can see why keeping the risk small on a trade is so important. Now for fun, imagine running this system, but instead of 2% risk you just throw in your whole account on 10x leverage in every trade like normie YouTubers tell you to. Yeah, good luck to you. Let's talk about stop losses now. On Bybit you can add them to your trades here. Where should we be putting them? Think to yourself, where does price have to get to for me to accept that I'm wrong? So below previous lows, below moving averages. If price heads back, these are all things that can act as support. I will also manually close my trade if Bitcoin starts dumping, because it might drag my coin down with it. Or if my coin starts to lose relative strength on the 5-minute. On Dash I chose to put my stop loss here, because it was below a bunch of consolidation and the 2150 and 100 moving average on the 5-minute. Meaning there's a lot price has to get through before it stops me out. I'm not going to bore you with the maths. Once you've picked your stop loss placement, just sling shit in the amount box until the expected loss is 2% of your account. So what are we using leverage for? Say you have your $1,000 account and you want to open 2 positions at $700 each. Well, without leverage you can't. You already know that your actual risk is 2% of your account, so $20 on each trade, so instead we are going to buy on leverage. Think of the $1,000 account as your margin for trades and not how much you're risking. So if you buy both of those $700 trades on 10x leverage, you committed $70 of your own money and Bybit committed $630 of their money per trade. You've used $140 of margin and have $860 of margin left. The amount lost in a stop is going to be $20 each, so $40 total, as we've sized our position, so a stop is minus $20. But using leverage, not like a chimpanzee, just let you increase the amount of trading you are able to do. Once you have your stop loss, now where do we take our profit? You can do 2 things. Either have a fixed target. I recommend 1.5 or 2 times your risked amount. Just remember, the smaller your target the more frequently you will win, but price will move way further than what you're banking. Leaving so much on the table like this means you'll never get those huge wins that return 10 to 20% of your account in one trade. But if you're new or your trading mental is made of paper mache, I recommend having a small target and playing to get your win rate as high as possible so your losing streaks are small. It's probably the best until you get consistent. Now, how to actually take profits so you get trades that return a third of your account in one go? It's simple. Just don't take profits. Use the trailing stop loss tool on Bybit and make your second trailing stop a little wider. And scale in, add more capital, get deeper in as it goes along. You already know which way it's likely to go, so why not commit more and more to the trade as it trends and your stop moves with it. This is how I take most of my trades. But I appreciate most people won't be able to handle getting stopped at break even this often before they win. I'm going to play you a part of a lecture on trading psychology, to maybe help put things into perspective. The whole thing is brilliant though. It's in the psychology playlist. I highly recommend you check it out if you have a spare couple hours.
And I happened to get to know Russell when he was in London. And he said, do you know what the worst thing about being a turtle trader was? It was that you were not allowed to take your profit. You could be long soybeans or wheat, and it would be climbing, climbing, and climbing, and climbing. And you would be making $1 million, $2 million, $10 million, $20 million, $30 million, but you were not allowed to guess where the top was. And it was unbearable. You sat there, and that money was burning a hole in your pocket. You were just not allowed, because what Richard Dennis advocated was that out of 100 trades you execute, 97 of them are going to be, nah, but 3 of them are going to be ka-ching. And you never know which one of the hundreds it is. So you just had to sit there on your bottom, sit on your hands. And I swear to you, he says, the hardest thing in the world is to sit on your hands and just let the market do what the market does.
Thanks for watching.